I buy multifamily real estate without using any of my own money, using JV partners where I do 60-40 splits, using social media to raise capital with abundance. And I'm going to show you exactly how I do it. Hey, my name is Ryan, and this is how I buy multifamily real estate without using any of my own money. So the basic overview of it is I bring in the deal, I help get financing approved for the deal through a broker or a lender, and then I manage the property once we own the building. Now, there's a lot to unpack here, so I've got my whiteboard to draw everything out so it makes sense. So first of all, you need to make sure you have a deal. Now, I like to make sure my deals are off market. I've done deals that are on market before, so it's not like you can't do it on market. But having an off-market deal allows you to be able to bring extra value to the marketplace, bring extra value to your potential investors, and have you separate yourself from everyone else trying to fund their deal. Okay, so how am I able to get these off-market deals? Now, I get these off-market deals through real estate agents, connecting with brokers, and building that relationship for long term so that they know that I can execute and they keep bringing me deals off market. Now, here's a couple of magical things that I do is that when I talk to real estate agents, I tell them, hey, I'm looking for expired listings or deals that are coming up. Okay, so those are your two magic words. Expired listings. Okay, that means deals that have already been listed for over a year but never got sold because the price was too high, and now potentially they're more interested in selling at a lower price. So those are expired listings. The other side of it is brand new listings. So what's going to happen is real estate agents have these sellers that's coming to them who wants to sell their building, but they haven't listed it yet because it takes time to list the building on market. You need to take photos, you need to walk the property, you need to gather all the T12, the cash flow, all the documents just to be able to post it on LoopNet, Corexi, or all these other websites. And so you're able to provide value to the real estate agents by offering to buy these buildings before they even need to put in the work to list it online. Okay, so that's what I do, and I get a steady stream of off-market multifamily deals every single time so that I'm able to provide maximum value to the marketplace when I go ahead and market it to my investors. Okay, so that's step number one, get an off-market deal. Now, what is step number two? You gotta break down the numbers and make sure that it cash flows for you and your investor so that when you do a 60-40 split, the cash flow still makes sense to your 60% investor. Okay, so you give 60% to your investor, to your partner, and you keep 40% to yourself. Now, I like to make sure that it cash flows at least 10% cash and cash return for my investor. Now, I've done deals where it only cash flowed 6 or 7% to my investor, and the deal still worked. But those kind of deals they were appraised higher than what we bought it for, and the rents can be increased. So there's a lot of different variables, but the main rule of thumb is to make sure that your investor can cash flow at least an 8 to 10% cash and cash return or more. Now, how do I do this? I use my own cash flow analysis matrix, which allows me to break down the numbers in less than 2 minutes. It's very vital that you spend not more than an hour trying to break down the numbers, given the fact you already have the T12 and the cash flow documents from your real estate agent or from the seller. Once you have all that stuff, you should not spend more than a couple hours trying to break down the numbers to see that if it actually works. So I like to break it down in less than 2 to 5 minutes because deals move fast. And if good deals exist, they usually go by really, really fast. So you need to have the skill of breaking down the numbers in less than 2 to 5 minutes. Now, this might sound crazy or unachievable, but trust me, if you have a cash flow analysis matrix, you just plug in the numbers, you see exactly how much cash you need to raise, how much the rents go for, so it spits out the gross rental income. You plug in all the expenses, the taxes, insurance, the utilities, the property manager, repairs and maintenance. It will tell you the NOI, the net operating income. Then after that, it shows you the amount of loan, the LTV, the loan to value that the banks will give you, which is typically around 75% for multifamily buildings. So after that, it will tell you based off the current interest rates and the amount of length of amortization, which is usually 20 to 25 years. It should tell you how much cash flow is left in the deal for both of you. So I want to tell you guys about the first ever deal that I was able to fund using this system that I'm about to show you. It was about a year ago, and it was a 9-unit apartment building. And I used none of my own money. I raised money from investors with abundance. And it was nothing like this. It was not 10% cash and cash return. And It was a building that we had to kick out all the tenants because it was in a really bad area and they were not paying their rents. So we put in about 200,000 in renovations, and we basically split up the bedrooms, increased the amount of units. So from 9 units, it became 20 units because the bedrooms were really small. If you guys want to learn exactly how I did that deal, I'm going to link the video right here. You can click on it so you can see exactly how I did that one. So going back to this, let me show you a little bit more in depth on this criteria. Okay, so what does cash on cash even mean? It is essentially the total amount of investment that your investor put up to close the deal divided by the total amount of cash flow, the 60% of cash flow that you're going to give to them. Now, let's say, for example, you have a 9-unit building for $50,000 a door. Okay, so the purchase price would be $450,000. Now, this is the purchase price of this deal, given that you guys didn't negotiate and this is the final asking price that the seller wants. Now, usually the banks would want a 20% down payment, usually 20 to 25% down payment. Depends on the type of lender, depends on the age of the building and where it's located, etc. There's lots of different factors. Usually, if it's outside of the city, they also require more down payment. Now, let's say for example purposes, you need 20% down payment of the purchase price $450. And using my calculator, it is $90,000. So $90,000 is your down payment that you need to raise from your investor, from your 60% partner. Now, there's still closing costs. Closing costs are usually the lender fee, broker fee. If you're using a broker, there's closing costs, there's a lawyer's appraisal cost as well, inspection, and a little acquisition fee for myself that I like to take for doing all of this. So I get paid an acquisition fee from raising the capital because I found the deal. I'm going to help us get approved for financing, and I'm going to be managing the building moving forward. So typically my acquisition fee is around $5,000-$10,000, depends on the deal. So let's say for example purposes, so I want $5,000 for my acquisition fee. The lender fee would usually be 1% of the loan amount. So let's say that's around $4,000. Lawyer and title insurance, title company, and closing costs around $5,000 to $10,000. So let's just say it's around $10,000 to be at a higher end. Now, usually the appraisal fees are also included in the lenders. The lenders would use their own appraiser, but just in case you need to use your own or you need to have your own inspector as well, we can tack on an extra $4,000 for that. Now, totaling all the other extra costs for closing, which is my assignment fee, lender fee, lawyer fee, and $4,000 for etc., we're at $23,000 extra added on top of the $90,000. Now, this might be on the higher end, so don't blow up on the comments. This is definitely on the higher end. Probably it's going to be around $15,000, but I just want to drive home that you want to be conservative with your numbers. So the total amount of cash you need to raise from your 60% partner would be $113,000. Now, to hit the 10% cash in cash, you need to make sure that after all of the expenses in the building, after the mortgage, now we're going to talk about the mortgage as well, but after all those, you need to make sure that the 60% cash flow remaining from your partner is going to be at least around $13,000 a year for them to hit 10% cash and cash return. All right, number 3, we're going to be talking about the lender or the broker for financing the deal. Now, this part is fairly important. We need to make sure that the lender actually does their work on time and they actually push for your papers so that you don't need to extend your closing or your condition dates. Quick story on this is I actually lost a $2 million deal, close to $2 million, on a 6-unit brand new building because my broker was not able to submit the files in time. Now, I'm not blaming the brokers. It's definitely my fault because I could have called them every day. I could have kept pushing, but essentially I sent all my papers in time. And what does the papers mean? That means my net worth statements, my property disclosure of mine and my partner on the deal. Okay, 60-40 split, the exact same thing. And we submitted the papers right on time, way before the due diligence period was going to expire. And it took them way too long to submit the papers. They were on vacations. They did not treat our file as seriously as they should have because they were working on bigger files as well. So that was a big lesson learned. I lost a $2 million purchase because they were just really slow. So make sure to always push your brokers, push your lenders to follow up with them, make sure your files are being pushed and it's not sitting on their desk doing nothing. Now, your deal could either have a broker who will deal with the lender, or you can just go straight to the lender. So who are these lenders? These are A lenders, TD Bank, credit unions, etc. Brokers are people who will find the best lenders for you on your behalf. Now, brokers typically charge around 1% of the loan amount. So if your deals are smaller, usually brokers will not take the deal because they like to charge at least 10K. So if your loan amount is less than $1 million, they're not going to look at your file because 1% of 1 million is 10K. That's where they want to be. So your purchase price is definitely going to be more than 1 million, right? So if you're dealing with smaller deals because you want to raise the capital easier, then you want to deal with directly with the lender. Now for the fees, lenders typically charge around 0.5% or 1% of the loan amount. It depends. And there's extra fees such as lawyer fees. So you're going to have to pay for their lawyer as well, and appraisal cost, and sometimes inspection as well. So these are just extra costs that you're going to have to potentially pay to your lender. It depends. Everyone's different, but this is what I've seen is in most cases. Here's a little tip on being able to get the best lenders or the best brokers is when you're doing a deal and it's from a real estate agent, ask your real estate agent for connections for lenders or for brokers because they have been in the game for a long time and you want to make sure that you are getting the best connections as possible. Ask your real estate agent for these connections. Another tip for number one here is remember, real estate agents have been in the game for 10, 20, 30 plus years, marketing their entire livelihood to get off-market deals to be able to list them. So commercial real estate agents that deal with multifamily buildings, it is really important for you guys to work with these people because, again, they spend their own money on bus ads, newspaper ads. They're spending their money to attract sellers of multifamily buildings. And if you're able to connect with these guys, these agents first, and incentivize them, telling them that, hey, you're going to close the deal, you're going to make sure that your papers and your finances are in order, they will send you the deals first. It's going to serve them because they want to get the deals done. It's also important to note that if you work with other wholesalers who already have the deal, it's going to be tough for you to execute this 60-40 split because you have more power if you have the deal. If you found the deal yourself and not through another wholesaler, you have absolute power in marketing it to your list to be able to close on it on your terms. Also, another problem is that if you're working with a wholesaler, they are probably marketing that deal to other buyers as well. So you're on a time crunch, you're fighting against other buyers, so it defeats the purpose of an off-market deal. Now it is on market. Because if it's with a wholesaler, they're marketing it to hundreds of other buyers. You don't want to be in that situation where you're competing with hundreds of other people. All right, now once you find a lender or a broker who will work with you on the deal that you have, make sure that you get the ballpark interest rate that will be for your deal so that you can plug it into your cash flow analysis matrix so you get the numbers correctly. And once you have the amount of yearly amortization that they will give you so you could plug it into your cash flow analysis matrix, then you're ready for the next step. All right, now you're ready to market it for a 60-40 split, 40% for you, 60% for your investor. Now, why does this work so well and why does this even work? Why would an investor put up all of the money and only take 60% of the deal while I take 40% of the deal? Let me actually show you a series of text messages that I got just this morning from an investor, a potential investor, giving me a rejection off of this notion. So I woke up to a text from a potential investor and he was asking me, hey, you have amazing lenders. Can you give me a connection for these lenders? And I quickly said, hey, listen, my lenders are only for my current partners only. I'm sorry, I cannot give them to you. And he responded saying, wow, that's really sad because that would have saved me a lot of time and legwork, and that wouldn't affect you at all anyways. I responded by saying, hey, let's say you're getting amazing off-market deals from a certain real estate agent. Would you be open to giving me his number or keep him to yourself? He said, that's totally fine. I would give him because I can't buy all the real estate anyways. Well then, he probably should learn what I'm about to show in this training so that he can raise capital from joint venture partners and buy unlimited amount of deals. After that, he texted me a thought experiment. He asked me, would I give him 40% of my car while I take all of the risk on the insurance and all the liability, and he does nothing and he takes 40% of my car? So here's the problem. He was stuck in the mindset that I was not giving him any value. I responded saying, if you find me a car that we can buy for less than the market value, you use it for Uber, drive it so it cash flows, and we split the risk 60-40. You'll be on the insurance name as well as me. Then whatever you take home from cash flow, we split 60-40 and I do none of the work. Of course I would do it, right? So that's why this model works so well, is because my investor does no work after putting in their capital. They have an incredible amount of cash on cash return. The purchase price is also on a discount from what it's worth. And I give them preferred capital payback, which means in the event that we sell at a profit, I make sure that my investor gets paid their entire lump sum investment amount first. And then afterwards, any profits left is split 60-40. And that's exactly why this model works. And guess what? That person who was texting me this morning, crickets. I didn't get a response from them even till now. It's been 5 hours and I still haven't heard from them. So I think they got the gist. So to recap, we found the deal. We want to make sure it's off market. If it's on market, that's totally fine. We can still do the deal. We just want to make sure that we do it fast, because if something is good and it's on market, it's probably gone within the next hour. So want to make sure it's off market. Again, don't work with wholesalers. Make sure you get your own deal through real estate agents or your own connections or property managers. However you can find the deal yourself, do it. My favorite way is through real estate agents, because again, they've done it for the past decade, 20, 30 years. They spent their money, their experience, their time, their reputation to source all of these apartment buildings, multifamily buildings, for them to list it. You just got to get to them first before they list it, or get the deal when it's already expired. So that way, no one else is looking at it. After that, you want to make sure you put it into your cash flow analysis matrix. Now, there's a ton of templates online, and you could even make your own, but I made my own. And if you want your own copy, just reach out to me on Instagram, comment the word analysis matrix, and I'll send you the copy for free. Next, you want to make sure that you have a lender ready for the deal before you even start marketing the deal. Okay, so your lender is going to assure you what interest rates ballpark range would be. Right now, as of current date, it's around 6.75%. On the high peak, it could hit around 7% as well. So you want to make sure you put in the peak of what the interest rates could be on your cash flow analysis matrix. So that way, your investor knows that you're being conservative. After all that, you're ready to start marketing for the 60-40 split. So now you probably want to know how we get an investor. We use social media. Social media is one of the most powerful tools that you can use. Make sure you use social media and not get used by social media, right? You want to make sure that people are scrolling to get your deals instead of you scrolling on social media. Now, there's a couple of things we need to be a little careful of when raising capital using social media. You can't just post, hey, I'm looking for investors for a deal on social media, because there's some SEC rules that you have to abide by. The whole idea here is that the SEC wants to make sure that you're not just raising 10, 20, 50K from some grandma and taking their money and running away. So there's certain rules to follow. If you're able to follow the rules, you're completely good. First, you want to make sure they become your friends and family. So there's exemptions when raising capital publicly. They can either be your friends or family. Now, how do you make someone your friend? You connect with them. You jump on Zoom calls with them. Perhaps you meet in person with them, and you catch up with them on a regular basis so that they become your friend. The second exemption are accredited investors. And now this is what I mainly use. Accredited investors are essentially people who have a certain amount of net worth or net income combined with their spouse, or if there's a certain amount that they need to hit. I believe it's $200,000 a year net income if they're single, or $300,000 combined with their spouse every single year. Now, for my deals, I buy luxury apartments, and they're usually around $250,000 a door or more. I like brand new, I like developing, and I like high-end products. And so that's what I do. If you're watching and you have never bought a single apartment building before, I suggest buying an existing one that already cash flows. They're usually going to be 1980s or newer, and the price per door is going to be somewhere around $40,000 to $100,000 a door. That way you don't have to raise a lot of money. Now, with the types of capital I like to raise as a beginner, I want to target between $100,000 to $200,000 per raise. So you need to make sure that your deal with a 20% down payment, you need to make sure that the down payment and the closing costs are just around $100,000 to $200,000 max, because you're going to be raising capital from just one person. You don't want to raise capital from 2, 3, 4 different individuals, because that becomes a logistical nightmare, and that's going to be so much work. So I recommend to just raise capital from just one person. If you need to raise 150,000, raise 150,000 from just one person. Now, the whole point with social media is to have abundance, because what's going to happen is when you pitch the 60-40 split, 80% or even 90% of the people who you pitch the deal to, they're going to say no, because people are greedy and they don't understand the concept yet. But 10% of the people are actually going to consider it. And from that 10%, you just need one person to say yes. Now, how do I do this? What I do is I create a Facebook group. Okay, so I own multiple Facebook groups. One Facebook group I have is about 3,500 people I grew from zero in under a year. And I was able to do that through some growth hacking strategies. If you want to learn some of these growth hacking strategies, just go to my Instagram, official Ryan Herrera, and ask for it. I'll give you some strategies right there. After growth hacking my group, I collect their emails from the pre-qualified questions that they need to answer before joining the group. So these people cannot join my group if they don't give me their phone number, their email, and how much cash they have, and how much experience they have in multifamily, or how many units they're looking for, and the state and the area that they want. So then I'm able to build a buyer's list from a Google spreadsheet of all these people joining my group, and I have insider information that no one else knows of how much cash they have, what their email address is, and what exactly they want. I then also post in my Facebook groups. And so what I want to do is make sure that it goes viral. Now, what does viral mean? If I get around 10 comments on my deal, that's okay, but I want to hit 50 or more. Now, how do you make sure that your deal goes viral on social media? You need to make sure that it is off market. If it's off market, it will blow up, and you will get 60, 70, 80 comments, even 100 comments. And all these comments are people giving you their email addresses or their contact info for you to send the deal to them for more information. A little trick here, a little tip for you guys is to include your phone number in the post. What's going to happen is when you include your phone number, people can then directly reach out to you. And this is what I do to absolutely blow up my phone. If you don't believe me, here's a recording of my phone every single time I have a deal and I post it on my groups. It goes absolutely bananas. Essentially, what's going to happen is you're going to wake up and you're going to have absolute pure abundance with investors knocking at your door. And what happens when you have an abundance mindset is that you're going to be able to perform better. And when you pitch these people on a Zoom call or when you meet them in person, you're not going to have any form of desperation. You're not going to lie about the numbers or the returns, because you have so many people reaching out to you that it does not matter. You don't need to close one certain person because you have so many more people. What's going to happen is you're going to build up a list on your Excel spreadsheet or in your Google spreadsheet that's going to compound and keep growing and growing every single week, so that you will have hundreds, even thousands of investors ready to partner up with you. Now, why do I create a Facebook group? Number one, it gives you a sense of credibility, gives you a sense of authority. You have access to insider information, which is how much cash they have, their phone number, and their email. Now, here's one pro tip, is that you should never share the address on your post or on text. The reason why is because people can go around your back and steal the deal from you, regardless if it's on market or off market. Never share the address until you spoke with them on the phone. Build that trust, and when you feel confident, then you can share the address. But this is one thing that I like to do before even giving the address, is I get their ID, okay? I ask for their ID. Why do I ask for their ID? Because if they're serious and want to put this deal under contract and buy it with me, they need the ID anyways, because you and your partner, you both are going to send your ID to the real estate agent to write up the deal and put it under contract. So again, never share the address, only give highlights of the deal overview, how many bedrooms, what the price is, approximate location, and your phone number for them to call you. And don't blame me once your phone starts blowing up when you're working your 9 to 5, because if you do the strategy correctly, your phone will absolutely blow up to the point where you cannot handle all of the inquiries. Another option is for you to actually assign the deal to someone. What's going to happen is when people start calling you and reaching out, a lot of them will ask you, hey, I don't want to do the 60-40 partnership with you, but are you open to just selling the deal to me and I'll give you an assignment fee? It's up to you if you want to do that. You absolutely can. Just make sure it's a decent amount of assignment fee for you to let go of a good deal. Now, what you're going to do is you're going to make sure that they sign a fee agreement with you before you give the address. Okay, once again, you make sure you have either their ID or you make them sign a fee agreement or a non-circumvent contract so that you are protected when doing these deals. So now you have an abundance of investors giving you their email or calling you, texting you. And of course, after you speak with them, they're going to want more information on the deal, even more information than what you posted, right? So what's next is structuring your email. So when you send out your emails, you need to make sure that you BCC these people giving you their emails, okay? Do not send it to the two. Send it as a BCC. BCC means blind carbon copy. So when you have a list of 100 people, let's say you have 100 different emails, you don't want them to see each other, of course. You want to make sure that they don't know that you are sending it to other people too. So that's why you put it in BCC. And then you send the two to yourself. So let's say your email is abc@gmail.com. Okay, this is your email. You send the two to yourself, and then the BCC to the other people, to the investors that's giving you their email. Okay, another pro tip: make sure you do this so that your investors don't see each other, and it's gonna be really awkward for them to see the other people that you're sending it to. Now, let's talk about the actual structure of the email. So I like to keep my emails very short, brief, and straight to the point. It goes something like this. I say, hello, my name is Ryan. I'm the admin of the group that you just joined. I have an off-market deal for you. We can do a 60-40 split joint venture, 60% for you, 40% for me. And then I tell them that my responsibilities are to manage, get us financing approved, and manage the building. I tell them my responsibilities are getting the deal for you, get us approved with financing, and managing the property for long term. Their responsibilities are to put up the cash needed to close the deal, and they also have final say on what type of tenants we're going to rent to, what the tenant prices will be, and the selling price. If we ever sell down the line, it's up to them if they want to sell or keep. That way, they still have majority of the deal, but you're able to buy the building with none of your own money. In the email, I like to attach my cash flow analysis matrix and a photo of the deal so that it looks nice and presentable. At the bottom of the email, I also like to tell them the amount of cash and cash return that they're going to expect from the deal, given the current interest rates and the amortization period that was given to us by our lender. So voila, that's what you do to create a very structured email that is so to the point. It gives them exactly what they want to see from the deal, what the cash flow that they're going to get from their 60% share, how much cash they need to put up for the deal, and their net worth requirement as well. Okay, now you've sent out the emails. You're going to have people replying, telling you either they want to do the deal, they want to negotiate with you, or they want to come see the building with you, or they want to come go see the building by themselves. So what's going to happen is now you're at this stage, you're going to be closing the investor. So there's a lot of tips and tricks that I can give you for how to do this properly and efficiently. But my biggest recommendation to you guys is to meet your investor in person. Now, if you're buying the building out of state, let's say it's 12 hours away from you, because you can definitely do this structure virtually. You can buy buildings anywhere in the States. I would recommend to fly out there and meet the person. Now, if you can't meet your investor because maybe they're traveling, they're out of the country, or if your deal is 15 hours, 8 hours away from you, and it's just it doesn't make sense for you to fly all the way there just to meet them to see if they want to do the deal, close them over the phone or a video call. Now, I've closed investors without even seeing them for them to put up the capital. So Again, when you're closing the investor, it's all about for them to know, like, and trust you. It's three things. They need to know, like, and trust you. And this is how you're able to build this system to then get to this point. Because again, you are sourcing them from your Facebook groups. You are making sure that the cash flow makes sense and the numbers are accurate, and you give them a deal that makes sense, which would be the 60-40 split for you guys. You bring in the deal, you handle the financing, and you manage the property after the fact. Let's do the deal. Now, what you're going to do is line out the exact steps for them next. So the first step is for their ID, okay? So their ID, their driver's license or their passport, is because you're going to be sending your ID and your partner's ID to the real estate agent who has the deal to then write up the contract, okay? Second step is telling him what the dates will be for the deal. So the first date would be the condition. Now the condition date is the financing, inspection, appraisal, and any deficiencies in the actual deal. So the condition tells you that you have an exit plan in just in case if the building has foundational issues or the rents were not correct or you guys can't get financing. Okay, so your earnest money will be refundable based on this. Next date would be the earnest money deposit. So the earnest money would be the deposit to tie up the deal. Now for the condition period, I suggest you guys give yourselves around 30 to 50 days for the condition date. Now, if you make it too long, the seller will not be comfortable and the real estate agent as well might feel that it's too long of a condition date. But this is multifamily and financing does take a little bit more time than single family. So you can actually get away with, again, 35 to 50 days for your condition. I usually buy around 2 to 3 months for my condition. Again, just make sure that your real estate agent, the one that brought you the deal, or the seller understands that these are the timelines, of course, and your partner as well. Now, the earnest money is usually 3 to 5 days, 3 to 5 business days for the actual earnest money deposit. So this is actually the first capital, the first step that your investor is going to put up. Now, this earnest money deposit, again, it's usually around 5 to 10 grand, maybe even more, 20, 30, 50 grand. Depends on the deal and depends on the seller. So let's say, for example, it is 10K. Your investor, when they want to do the deal with you, first step, they give you their ID. Next, they put up the 10K deposit to the real estate agent, the one that brought you the deal, or to the seller's trust account. Okay. And then step number 3 would be to start doing the work. And the work is the paperwork. So paperwork. So what is the paperwork? The paperwork is the net worth statement that you and your investor has to fill out based off what your lender wants. Now, again, you will know what documents your lender wants because you already spoke to them in step 3. Okay, so your lender, let's say, for example, is TD Bank. TD Bank will want property disclosures, net worth statements, credit score, etc. for this paperwork. So now you have 35 to 50 days to fill out this paperwork. Now you guys know how to close the investor. We're going to be talking about step number 8, which is the USA. Okay, now what is the USA? It is not United States of America, although, of course, go America. USA stands for the Unanimous Shareholders Agreement. So what is this Unanimous Shareholders Agreement? This is the contract. It acts as a JV, a joint venture contract between you and your 60% partner to ensure that everything is cut and dry, black and white on the actual agreement so you guys know what's going to happen. Now, in this USA agreement, there's going to be a lot of different terms, a lot of different agreements and structures in place. What I like to use in my USA agreements is I like to have at least a shotgun clause and a first right of refusal. Now, I'm not a lawyer, so make sure you check in your state and talk to your lawyers, but I'm just giving you what I do in my contract so that hopefully it'll save you and your lawyer lots of time and lots of money to structure this. So this will help you to close your investor, because once you guys sit down with your investor who wants to partner with you, or over a call or over a Zoom video meeting, this is what's going to tie the partnership together. This is what's going to help your investor be protected and yourself be protected. So what happens if I stop managing the property manager and I just I let the property run to the ground. Well, there's a shotgun clause, which means at a high level that my partner can buy me out of the contract, buy me out of the building at a discount, because I don't deserve the entire 40% value of the building if I defaulted on my responsibilities. If I was supposed to manage the property manager and I stopped doing that because let's say I just got lazy or I retired, I went to Italy and just retired, my partner can exercise the shotgun clause and buy me out, which then is at a discount. So usually at a significant discount. So that clause helps your investor. There's also a first right of refusal, etc. Now, this unanimous shareholders agreement is vital to ensuring that your partnerships go smoothly, because I've heard a lot of horror stories of partnerships going sideways, a lot of people burning each other, and they don't have everything in writing in actual clarity. Now, I also have in my USA a preferred capital payout. Now, what does this mean? It means that the initial capital that my 60% investor put up for the deal, let's say $200,000, in the event of a sale or a refinance or a 1031 exchange, my partner gets the $200K first before any 60-40 split on the profit. So let's say we bought a property worth $1 million and we sold it for 1.5. That $500,000 profit, $200K has to go out first, goes back to my partner. Okay. So I need to make sure that my partner breaks even first on their $200K, and then the remaining $300,000 profit is then split 60-40. Okay. So that's why my partnerships work. The 60-40 model works so well because it's a win-win for the investor. Now, if you guys want to see a detailed breakdown of my USA, I also did a short video on this that you guys can click over here, or you guys can message me on Instagram, official Ryan Herrera, and I will send you guys the video over there. Now that you've finished all of this, you got a deal, you made sure the cash flow works, you did the 60-40 model split, you marketed it on social media, you have your growing list of investors in your Google spreadsheet. You then close the investor from the amount of people that you blasted on your email. Now you're at the part where you raised the money and you made them sign the USA. All right, so now you've gotten to this step. Congratulations. Now you got an investor and you are under contract on a building using none of your own money. And you got it with abundance too. So recap, you got an off-market deal. You made sure that the numbers worked with your cash flow analysis matrix. Make sure you don't spend more than an hour. I spent only 5 minutes in breaking down the numbers so that we can move on to the next deals if the numbers don't work. Next, you get a lender and broker to confirm the interest rates and the amortization period. 60-40 split, you blast it on social media. Then you're able to grow your email list on your Google spreadsheet so that you don't have to start over from zero when you buy the next deal. You're actually growing your investor base. Then you BCC hundreds of people. From that, you're able to get one investor, then you make them sign. They send over the earnest money deposit. Great. Now, what are you going to do after this step? So actually, number 9, we're going to talk more about the logistics of how this all works. Is now you're going to open a bank account. Okay. Now, this is assuming that you made an LLC already. Now, to quickly touch on the LLC, you want to make sure that you create an LLC. So let's just say create a bank account LLC. Okay. So when you create the LLC, you're going to be 40% shareholder and then 60% for your partner. Now, there's a lot of ways to open an LLC online. So you can look them up, or you can always go through your lawyer. So when you open up your LLC, that's where you're going to submit all these documents to your broker when they ask for the documents, your net worth, etc. You're going to make sure you send it as an LLC. Okay, so you're still going to be sending your own personal net worth and your personal credit score, etc. But because you have an investor, both of you can be in the LLC together as one file so that you don't have to worry about your low credit score or if you don't have enough net worth. I didn't have enough net worth when buying my first building a year ago, but because I had investors with me who had a decent amount of net worth, we were able to get the deal done. Okay. So step 9, open the bank account, first you need to open the LLC and then you open the bank account. From there, you give permission to your investor, make sure they have access to the bank account as well. Now, in terms of distributions, you will be paid off as dividends. Now, talk to your accountant. I am not a tax expert, so don't take my word for it, but essentially you want to pay your guys out yourselves as dividends so that it's taxed lower. And if you have a holding company, you can flood your dividends to your holding company. If you want to pay yourself personally, you can do that as well. And of course, step 10, which I ran out of room, so I'm not going to write it, but step 10 is to manage the property manager. So they manage the property. So if your property is not in your state, I do recommend when you close the deal, take a flight, go see your building, take pictures, take videos, so that you can have it in your portfolio, because real estate is all about telling a story. So you're able to compile all of your properties under a website or on your social media, you're able to raise capital easier for the next purchase. So again, this is how you can go from zero buildings to your first ever building, because going from 0 to 1 is the hardest, but going from 1 to 5 is easier. Now, of course, there's more advanced structures and advanced strategies to all of this, but this is just a high-level overview of what you guys should be doing to get your first building. And I hope this video helped you. And if you found a lot of value to this, subscribe, hit the like for more of my real estate secrets.